Markets appear to be in a free fall as of late with current tariff talks. Market declines and portfolio losses are one thing, but turn on the news and listen to the rhetoric around this latest decline, and it seems like the worst is yet to come. Many CEOs, economists, and talking heads seem to think a recession is imminent if the US continues on the path it's on. Well, I think the viewers watching this video are hit with enough negativity and fear-mongering on a day-to-day basis. I hope with this video to help balance out the narrative and show you 10 charts that should give you some confidence during this latest market panic. Chart number 1, I would summarize that stock markets are driven by 3 things. Number 1, valuation of companies today. Number 2, valuations of companies tomorrow. And then number 3, uncertainty. The third one is key in the latest downturn. Financial markets hate uncertainty, and it appears right now uncertainty is driving the majority of the latest decline. Much of the current economic data is, maybe let's not label as super positive, but we certainly would not label as negative either. US unemployment is still far below its historical average. Inflation has dropped back down to lower levels. Forward-looking valuations are currently at 5-year lows. On the flip side, as noted with the chart on the screen, economic policy uncertainty is near the highs we've seen over the past 20 years, both on a single reading as well as on a 4-week rolling average basis. As a comparison, we are around 2020 pandemic levels and are higher than the 2008 financial crisis levels. Although there can be some pain leading up to these levels of uncertainty, generally speaking, these are a counter indicator of things to come. Chart number 2, we have CNN's Fear and Greed Index. This is an index meant to measure the sentiment of the stock market based on 7 indicators from bond demand to stock market breadth, and is currently near its lowest level on record. You know the classic and frequently quoted Buffett line about buying when there's blood in the streets? This is an indicator designed to identify when the blood is flowing. Once again, this is a counter indicator. The theory behind the indicator is that investors should take an opposite approach of sentiment. When fear is greatest, this typically represents a positive sign ahead. Looking back on this index overlaid the stock market from 2013 to now, we more or less see the validity in the indicator's theory. Here's the same overlay from mid-2021 until now. I've circled some of the previous low points on the chart to help identify additional times when fear was the highest. A good portion of the time we see market reversals following these low points. Now, one big disclaimer before continuing with this video. I'm not making any predictions with these charts. That's not my game, and you should not use these charts as such. My game and the game of our clients is to build a strong long-term plan and then stick to that plan. These charts are meant to aid in the psychological side of this goal. There's always positivity to be found despite what the media portrays. Chart number 3 is looking at a fear index of sorts known as the VIX. This doesn't measure fear per se, but rather measures the market's volatility expectation for the next 30 days and is derived from S&P 500 options data. Not surprisingly, VIX is climbing to some of the highest levels we've seen in the past 35 years, and further has seen one of the biggest one-week spikes over the same period. None of this should be too surprising given the market activity that we've lived through over the last week. What may be surprising to you is that high levels in the VIX and big weekly spikes is once again historically a counter indicator. Looking at the left-hand side of the screen, we see that on average, forward returns after one of the 20 biggest weekly spikes in the VIX are on average plus 11.3% on a 1-year basis and plus 23.9% on a 2-year basis. If we look at the chart on the right-hand side of the screen, we see additional positive data. Forward-looking data based on current VIX levels is even higher. Now, I will note there is some overlapping data as other data points cluster around the global financial crisis and the COVID crash, but nonetheless can give investors a silver lining to consider during this current downturn. Chart number 4, late last week we saw a 2-day decline equaling more than 10% in the S&P 500. This has only happened a handful of times in the past 70 years. Each time we've seen this swift of a decline, it has typically happened near the end of a market downturn, not at the start of a market downturn. Oftentimes an outlet like CNBC will use a stat like down more than 10% in 2 days as a terrible indicator of things to come. However, from the hard data, we see that historically it's been quite closer to the opposite. We can look at the same data with the NASDAQ, a more tech-based index. The NASDAQ has been a more volatile index historically, so we have a few more data points to look at here, but more or less reach the same conclusion. Chart number 5 shows us the percent of stocks in the S&P 500 above their 50-day moving average. A 50-day moving average is just a rolling average of the last 50 days of prices. Generally speaking, a stock above their 50-day moving average is trending up. A stock below their 50-day average is trending down. We are near some extreme zones in terms of stocks being oversold, with less than 8% of stocks currently above their 50-day moving average. On the right-hand side of the screen, there is a table showing forward-looking returns when stocks are in the bottom 2% of readings, which we are currently at. Subsequent one-year returns on average are around 30%, indicating the last couple of weeks may have been a disappointing time to be invested, but the next couple of weeks and months show something completely different. A giant mistake I see with a lot of investors is they see a downturn like this, and then they hear from media pundits on just how bad things are going to continue to get from here. Already in an emotional state, many investors will make a big, misguided investment decision like taking portions of their portfolio to cash. Sure, markets are down 15 to 20%, but it sounds like I could go even further to negative 30 or 40%. If I can just go to cash, maybe I can get back in when things become a bit more certain. This is your annual reminder that rarely does market timing ever work out. In fact, most of the time, it sets your portfolio back months, if not years. Decisions in the future don't get any easier. Say you go to cash and the market recovers 10%. Well, you've already missed out on that growth, but now you need to decide if we're actually in a recovery and you're going to jump back in, or if this is a false recovery. Say you were quote unquote right to go to cash and the market falls another 10%. Well, is this the bottom? I can tell you that fear will only be higher the further the market drops. Investors that make this mistake suffer from the illusion of future certainty. Right now is uncertain, but in the future, things will be much more certain and we'll have more data. You will have more data, but the future will remain just as uncertain. The problem is chart number 6 drives home, time in the market is more important than timing the market. If you invested $10,000 from the 20-year stretch starting in 2003 and stayed invested the entire time, your $10,000 grew to almost $65,000. Mistimed the market and missed out on, let's say, the best 10 days, and you have less than half the money at the end. Miss out on more than the 30 best days, and you end up with less than you first invested. And the biggest issue here is the best days in the market don't take place during good times, but rather the bad times. 7 of the 10 best days happen during a market decline. So if you have a strong long-term plan at the start of this year, the worst thing that you can do right now is override that plan for emotional reasons. It's likely to cost you greatly. Chart number 7, we have something called the high yield spread. The high yield spread is the difference in yield between high yield or junk bonds and a benchmark bond measure such as investment grade corporate bonds or treasury bonds. This spread reflects the extra yield investors demand for the higher risk of default of investing in high yield bonds. A wider spread or higher index value in this case suggests greater perceived risk and the need for higher expected returns, again, when investing in high yield. Right now, the high yield spread is below historical averages, let alone comparing to some of the highest index values we've seen in recent history. Given current levels, the bond market is not pricing in the same level of risk that stock market investors are currently fearful of, which should be looked at as a positive point. Worth noting, this can change in the future, however. Chart number 8, inflation has fallen to some historically satisfactory levels. Here we are looking at an index called Trueflation rather than the Bureau of Labor Statistic data. There are a few complaints one can levy at normal CPI data as they look at less data over time and have made some changes that some economists find fault with. CPI data takes into account about 80,000 data points, where Trueflation takes into account about 14 million data points. Currently, Trueflation's one-year inflation estimate is around 1.5%, almost half of what CPI has been reporting. On the flip side, Trueflation calculated inflation in the 2021 to 2022 timeframe to be much higher than what CPI reported, nearing almost 12%. The important positive point here is that inflation seems much more under control as compared to previous concerns. Given that long-term inflation has become a big concern for retirees in the last few years, this is an incredibly positive sign, even if tariffs slightly add to that current inflation. Chart number 9, the latest pain in equity markets is not something anyone likes, but it's something to be expected. On the screen, we have the maximum intra-year drawdown for each year in the US stock market alongside the overall return for that year. Feeling pain in stock market investing is a feature, not a bug. You earn higher returns in the market when you are willing to hold and suffer through the bad and uncertain times. The average intra-year drawdown since 1950 is almost 14%. Now, the current year's drawdown is greater than this, and many investors might think there's no way that the market can recover from here and end up positive by the end of year. Well, history tells us differently. 2009, 1998, 1987, and 1970 were all years where current drawdowns were larger than this year's current drawdown, yet the market ended quite positively on the year. Now I have no idea where this year's return will end up. What I do know is that the current market activity is not all that uncommon. Yes, the reason for each downturn changes year to year, but over the long term, investing in businesses is an amazing way to grow your wealth. Don't let short-term negative performance prevent you from earning long-term positive performance. Then with the final chart, I want to zoom out and remind everyone of the big picture we have here. Set aside all of the opinions of the current political policy and the current uncertainty in financial markets. Uncertainty is and forever has been a constant in American history. But a lot of wealth has been built through uncertainty, and this will continue to be the case moving forward. On the screen, I have a chart that notes some of the biggest events in history that have been far more uncertain than what we face today. These events involve world wars, countries collapsing, risks of nuclear war, terrorist attacks, and more. Yes, short-term pain may be felt in the short term, but over the long term, human innovation has consistently won out. That's what you are doing when you are investing in the stock market. You are owning parts of some of the best, most innovative companies in the world. Apple, Google, and more. Don't become permanently devalued because of a tariff policy. Zoom out and remember exactly why you are investing in the first place, and remember that what the economy is going through right now is largely normal. Also remember that every market cycle offers you the ability to propel your retirement plan forward. Sure, portfolio values aren't rising right now, but you can use strategies like Roth conversions and get more out of your conversions right now. You can tax loss harvest and use these losses to lower your income in this year and future years. You can also use this downturn to get out of bad positions that you're holding and reinvest in more efficient alternatives. Now, I hope you found some positive notes in today's video to combat the constant negativity you are hearing from major news outlets. If you are looking for some additional content on what a market crash or recession might mean for your retirement spending and income, click on one of these two videos right here. And always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.